Welcome to my first video in my channel. I want to start very fast to give you great investment idea for the coming year, 2023. Merry Christmas guys. Let's start. Stocks had a terrible year in 2022. The tech-heavy Nasdaq Composite fell more than 30%, the S&P 500 lost 20%, and the Dow Jones Industrial Average is down almost 10%. Blame the conflict in Ukraine, the Federal Reserve's hawkish stance, the inflation crisis, or the impending global recession. In order to find top fund managers who have outperformed their benchmarks this year or over the course of 3, 5, or 10 years, here are their top stock recommendations for the upcoming year. The first company is Duolingo. Market capitalization, $2.9 billion. 12-month revenues, $338.7 million. The education technology company Duolingo, known for its app that teaches languages, is one of the fund's more recent additions. It came from the company's July 2021 IPO. The company's shares have decreased by about 30% this year. With roughly 15 million daily users, the app provides totally free language lessons in the form of missions that are unlocked in a specific order, each mission containing a different lesson that is dynamically and adaptively built to suit the needs of the individual learner. She continues, staying motivated to continue studying is one of the hardest aspects of learning a new language, especially if you don't live in that country. To address this, Duolingo has adopted a gamification strategy. The company has been able to grow organically with relatively little marketing spending because the app is free to use, freeing up more money for product development. The next one is Shopify. Market capitalization, $43.6 billion. 1-year revenues, $5.2 billion. Canadian e-commerce behemoth Shopify is the fifth largest holding in Baillie Gifford's U.S. Equity Growth Fund, despite its shares falling more than 70% in 2022. According to Gibson, the company is aiming to be the brains that power millions of businesses around the world. She continues, describing the company as discretionarily unprofitable in that it is choosing to invest in new markets for the long term at the expense of short-term margins. Shopify's stock was once very much a pandemic darling, but it has since experienced a significant price drop as companies that are taking losses for future growth have been pulled down by market sentiment. Gibson also appreciates the company's foray into enterprise markets and the introduction of Shopify Audiences, a premium tool that aids companies in acquiring new clients through targeted digital advertising on various websites like Facebook or Google. She concludes by saying, "We think we will continue to see Shopify's ability to adapt and be resilient in this current environment." The next one is Chord Energy. Market capitalization, $5.5 billion. 1-year revenues, $3.2 billion. Lemonades likes Chord Energy, which he describes as ideal for a choppy market period because it is a defensive play with huge cash generation and is currently trading at an extremely attractive valuation. After Oasis and Whiting Petroleum successfully merged, the company was founded in July and now owns nearly 1 million net acres of drilling rights. Both had previously invested billions of dollars in developing resources in the Permian Basin. As a result, during the pandemic, numerous fund managers, including Lemonades, purchased the two companies' distressed debt for pennies on the dollar. He notes that while Oasis and Whiting each had valuations far above that at their last peaks 5 years ago, while Chord Energy's market cap is currently $5.6 billion. According to Lemonades, the two recently merged companies are producing far more oil today than they were back then. Back then, oil prices were roughly $80 per barrel, and today they're basically around that. He also likes how very shareholder-friendly Chord Energy is, returning the majority of its more than $1 billion in free cash flow to shareholders over the past 15 months in the form of dividends or stock buybacks. That's cash money in shareholders' pockets. The next one is Becton Dickinson. Market capitalization, $71.5 billion. 1-year revenues, $19.4 billion. As a good defensive growth company with respectable earnings visibility, Huber likes BD. The fund has owned the stock for a while, but due to disappointing margins and an FDA recall on its Alaris infusion pump last year, it has had difficulties. The company has gotten its act together, according to Huber, who notes that it has a strong pipeline of new products, a strong cost management program, a few small M&A deals, and steadily increasing margins. Nevertheless, the worst is behind it, he adds. Although the relaunch of BD's Alaris pump is still uncertain and most likely won't occur until at least 2024, he claims that this has boosted sentiment. Whether a company's problems are self-inflicted or caused by the market, Huber asserts that there is good money to be made as the company recovers and emerges from a difficult period. Furthermore, BD's dividend yield, which is currently around 1.5%, is rising steadily over time, which is a sign of a healthy, consistently growing business, according to the analyst. In a world where interest rates are rising and growth is slowing, all of that is significant. The last one is Zebra Technologies. Market capitalization, $12.6 billion. 1-year revenues, $5.7 billion. With a focus on barcode scanning and inventory tracking technology, this market leader in enterprise asset intelligence trades at a significant discount to its underlying intrinsic value, claims Kurt. Large customers of Zebra Technologies include Target, Amazon, and many others from a variety of industries, including manufacturing, transportation, healthcare, and retail. Due to its ties to the technology sector, the stock, which was trading at $600 per share just 1 year ago, has undergone multiple compressions and has experienced a significant dislocation. It is currently down to $250. Kurt claims that despite this, investors continue to underestimate the company's fundamental earnings power. Decades ago, the business model focused only on scanning a barcode. Now, the complexity of logistics and tracking assets is ever increasing. He has high hopes for some of Zebra's more recent technologies, such as radio frequency identification, RFID, which tracks and identifies various objects in motion using electromagnetic fields. Despite Wall Street's worries about an economic slowdown, Kurt contends that during the nearly 10 years that the fund has owned Zebra's stock, the company has continued to adapt and grow and will do so going forward. If you want to know how to make money with investment, crypto and last updates in finance and stocks market, you can subscribe my channel. If you like video, don't forget to click like button and write comment. Thanks for watching. Have a good investments.